Every ETF has a story, and some of them deserve to be told. ETF Stories from Resilient Advisor brings you some of the most interesting stories from the world of ETFs. Learn more by visiting etfstories.com.
You are watching ETF Stories from Resilient Advisor. My name is Jay Coulter. By now, you know we like to bring you interesting stories from the world of ETFs. We are now syndicating this show on the newly launched Financial Advisor Television Network. And on this episode, we're going to share the story of the Quadratic Deflation ETF, symbol BNDD. My guest is Nancy Davis, the founder of Quadratic Capital Management, and this is her second appearance on the show. She came on to talk about her iVol ETF in a previous episode, which can be found by visiting etfstories.com. Nancy, thanks so much for coming back on the show.
Thanks for having me. Great to be here.
So we're going to tell the story of BNDD. I'd like to start by playing a video from your website that kind of makes the case for why and how for BNDD. Every ETF should make an explainer video like that to lay out the case for why it should be considered for a portfolio. Let's walk through it. So when you look at the problem that BNDD solves, what type of framework do you use?
So what we were trying to solve for investors was giving them a bond fund that has an asymmetric payout if bonds rally. Typically, bonds rally when equities sell off or in a risk-off environment. And a lot of investors, to get exposure to bonds, they might use leverage or other instruments. And so we're trying to give investors, because owning duration is a risky thing, right? There's lots of sensitivity to interest rates with long duration portfolios. And so BNDD is trying to accomplish that exposure to bonds, but in a way that has a convex payout. So meaning you make more when bonds rally, but if bonds sell off, you have that, at least with the options piece, defined downside.
So when I was looking through the investor deck, it appeared to me there were three themes that really are important for investors to consider as it relates to considering the impact of deflation on their portfolio. The first is the debt machine. What do you mean by that?
So what we mean by that is just the developed world has, we've taken from the financial crisis a debt bubble that was in, individual, balance sheets, and we've shifted it onto sovereign balance sheets. So around the world, we are experiencing a tremendous amount of sovereign debt. And in the United States, we've also embarked on, massive fiscal spending, which just means more and more debt. And so we're really saying, instead of trying to fight the debt machine, this is a way to potentially embrace it and say, look, debt is a reality. It is growing. And we live in a world of, pretty crazy things, especially in developed countries where we have negative interest rates. And it's really a penalty against saving.
The second dynamic that you're really trying to make sure you provide protection for, the demographic issues. What are your thoughts?
So the reality is in the developed world, we are getting older. I think the pandemic has also sped up some people's desire to retire early. They're calling it the Great Resignation, and the reality is many people are living off of fixed income portfolio these days, and the world is getting older in the developed world, and so because of demographics, maybe there is this kind of push for more fixed income into portfolios.
And the third dynamic that really stood out to me in your deck is the challenges with extreme indebtedness. What do investors need to be careful of there?
So there is a lot of debt in the world, and the question is whether there could be policy mistakes or other mistakes where, is the United States going to become the new Japan, where the Nikkei, which is the Japanese equity market, if you look at a long-term chart, the Nikkei peaked out in 1989 and has never recovered to levels seen in the late 80s. And we don't know, obviously, what the future holds, but for investors who are worried about the growth situation in the United States, worried about the massive amount of debt that has been accumulated, this fund is potentially a way to have a more, I'd say, defensive, concentrated position in bonds without taking credit spread risk.
All right. Before we get into the details of how it's constructed, is it fair to say that there's some similarities between the U.S. and that construct and Japan?
Well, we do have aging demographics for both countries. We do have a need because of the demographics for fixed income instruments. The US has been in a very growthy environment for a long time. And I think the question is whether that growth that has been priced in will actually materialize, or whether, this is all just financial inflation and not real growth, and whether, we potentially might see an unwind of some of the asset price appreciation that's taken place so far.
All right. So let's talk about the ETF, BNDD. When did it launch?
It launched very recently in October. It launched. So I'm sorry, September. So it's been less than a month. We actually rang the closing bell on the New York Stock Exchange yesterday. So it was very exciting. Thank you to the NYSE for that opportunity. So it was fun. Do you want to see a picture of it, or I can email it to you afterwards?
Yeah, send it over. We'll throw it in the broadcast.
Yeah.
So when we look at BNDD, there are some value proposition points that you lay out in your deck. And one of them is unique access. What does BNDD provide that the individual investor could not go out and get on their own?
So BNDD provides access to the rates market, the interest rate markets. They're some of the biggest markets in the world, and all global investors tend to access the rates market. So, for instance, when AstraZeneca needs to raise more money for vaccine research, they might issue a bond in dollars. And when they issue the bond, they hedge their rate exposure in the interest rate markets. So it's a huge global market that includes all corporates globally, as well as insurance companies, other institutional investors. And what we're providing access to is, it's mostly treasuries. So we use the long-term treasuries. We actually use a Vanguard fund to get our passive bond exposure. And then we supplement that treasury exposure with fully funded long options that give exposure to the interest rate markets.
Well, and that kind of dovetails into the asymmetric upside that you would like this to provide. How does that work?
So sometimes it's referred to as convexity, having that positive asymmetry, meaning that when bonds rally, this would have an asymmetric payoff when bonds rally. Conversely, when bonds sell off, we could underperform just regular government bonds without the options component. But the options component is fully funded long only, so we know our downside. So it gives the convexity, the positive convexity in a bond rally, which typically happens when equities sell off.
want to share a chart from your investor deck, and this is on the 2s and 30s curve. Walk us through what we're looking at and the implications.
So what this is it's a difference between interest rates at different points in time. So interest rates around the world are set by central banks, the policy rate, but then the term premium of interest rate, which is where interest rates are at different periods of time, is largely market driven. And so what this fund accesses is the difference. It's a spread product. So most investors are familiar with credit spread risk, which is, taking interest rate risk plus adding spread risk to corporates. BNDD does not take corporate spread risk. We take interest rate spread risk. So it's just another type of spread risk that's different than what most investors already have, which is whether it's investment grade or high yield that is spreads to corporates. BNDD uses spreads to the difference between the 30-year interest rate and the 2-year interest rate.
All right, so let's break down the portfolio construction, and let's do this for somebody who is looking to diversify their fixed income exposure and what they would be getting by adding this to their portfolio.
So what BNDD accesses is long-term treasuries. That's the bulk of the portfolio. And then we augment that position with options that are long options that are on the shape of the term premium of interest rates. So this fund benefits when 30-year yields go lower, meaning bonds rally. But it also can benefit from if we had a policy mistake or the Fed was very aggressive in hiking. So it also does well with higher short-term rates, which would be more aggressive Fed. So say an investor thinks the Fed might be hiking very aggressively, and that will cause growth to fall and equities to sell off long-term. This could be a potential fit given that view.
So for a financial advisor, portfolio manager, or investor looking at adding this to a portfolio, where exactly do you feel it fits?
So this would be a replacement for long duration government bonds. So instead of having just regular linear government bonds, whether it was TLT or other governments, this is a higher duration, more concentrated portfolio. So it could potentially be more capital efficient because if you have, X percent in government bonds, this would give you more sensitivity to a bond rally. It's also riskier than just regular bonds because it has that asymmetric payout. So it is very long duration. It's duration plus. So it's for investors who really are concerned that maybe we are becoming Japan. Maybe the debt machine is too much. Maybe bond yields are going, some people think bond yields are going to zero in the long end, and there's just going to be no growth in the market. This might be an appropriate fund for those investors.
What is the target duration of this ETF?
So the duration of the Vanguard fund that we own is about 18 years. But BNDD has exposure to the shape of the curve. So it's a more concentrated way of getting exposure to lower 30-year yields. So when bond yields go lower and bond prices go higher, or if the Fed has a policy mistake and hikes more in the front end. So either way, this fund could do well. So a more hawkish environment, which topples growth, or a risk-off environment that potentially would mean government bonds are bid. It has exposure to the shape of the interest rate curves.
All right, so it's going to be longer than the Vanguard product, but how much longer it is in terms of the duration is just going to depend upon what you can find in the options market. Is that correct?
So the options don't actually add duration to the portfolio. They just add convexity. They add that asymmetric payoff. So It's not longer duration than just the regular government bonds, but it gives exposure to either 30-year yields going lower, meaning bonds higher in the long end, the super long end, or the Fed hiking more aggressively and having higher 2-year interest rates. So it's either or with the options component, but the options don't add duration to the fund. They just add more convexity in case bonds do rally in the long end and yields go lower. So it's a very concentrated long duration strategy.
Nancy, I learned something every time you come on the show. I really do appreciate it. For advisors and investors to learn more about BNDD, please visit bnddetf.com. That's bnddetf.com. Nancy, thanks for coming on.
Thanks for having me.